Welcome back to Coin Flip. I'm Derek Wu, and today's episode is one of those rare ones where the boring answer is genuinely worth your attention. Here's the setup. The Fed meets on June 17th, 9 days from now. Polymarket is pricing a 99% chance of no rate change. So yeah, nothing's happening. But that's actually not the story. The story is what comes out alongside that non-decision, the dot plot, the economic projections, because those are the signals that tell you whether savings rates hold steady or start sliding. And right now, according to Bankrate, the top high-yield savings accounts are paying up to 4.10% APY. The national average, 0.38%. That's not a rounding error. That's money sitting on the table every month. So we're going to spend this episode helping you figure out what to actually do with your cash before the dot plot shifts the conversation. 3 things on the agenda today. First, we frame the June 17th meeting as a personal finance deadline, not a macro event you watch from the sidelines, a deadline. We'll look at what Polymarket's 99% no-change pricing means for your savings account and why the dot plot matters more than the rate decision itself. Second, emergency fund sizing. The important thing to understand is that the standard 6 months rule is a starting point, not a law. We'll talk about how to size it for your actual situation and why every dollar of that fund belongs in a high-yield savings account earning around 4.10% APY instead of a traditional bank at 0.38%. And third, the CD question. If the Fed is on hold and rates might fall later, does it make sense to lock in a rate now? We'll walk through the high-yield savings account versus CD trade-off, what early withdrawal penalties actually cost you, and why a CD ladder might be the most practical answer for people who want rate protection without giving up all their liquidity. We'll close with a 2-step checklist you can run this week. Practical, specific, takes about 15 minutes. The boring answer, as usual, is probably the right one. Let's get into it. June 17th, market. That's when the Federal Reserve wraps its next meeting. And almost nobody in your personal finance life is talking about it, which is a problem because it actually matters for your money right now. Here's the thing. The Fed's rate decision itself is basically a foregone conclusion. Prediction markets on Polymarket are pricing a 99% probability of no change. The target range stays at 3.50 to 3.75%. Done. Boring. Move on. But the boring answer is usually the right answer to pay attention to, and the real story isn't the decision. It's what comes out alongside it, the dot plot, the updated economic projections, new Fed Chair Kevin Warsh's first press conference as chair. That's where you actually learn something. Think of it this way. The sale price doesn't change on Sunday, but the sign still comes down. You can shop now, or you can shop after the sign is gone and hope the price held. June 17th is that Sunday. The window matters more than the meeting. So what's the actual window? Well, according to Bankrate, well-run high-yield savings accounts are paying up to 4.10% right now. That's real money sitting in an FDIC insured account, not a stock, not a bet, just cash earning over 4%. And Polymarket traders are currently putting 80% odds on 0 Fed rate cuts all year. If that's where rates are headed, those 4% plus savings rates don't stick around on their own. Banks drop them as soon as the Fed signals otherwise. JP Morgan's base case as of this week is the Fed holds steady through the end of 2026. So cuts may be further off than most people assumed heading into this year. That's not a disaster. That's actually an opportunity if you act before the narrative shifts. The dot plot on June 17th could confirm that view, or it could signal cuts coming sooner than expected. Either way, that's the moment when rates on savings accounts start moving. So before we get there, the question isn't whether the Fed does something dramatic next week. They won't. The question is your cash actually positioned to take advantage of rates while they're here? And that question has a very specific answer depending on where your money is sitting right now, which is exactly what we're going to sort out. So with that framing in mind, here's a question nobody actually answers. You've heard 3 to 6 months of expenses your whole life, but has anyone ever told you where that money is supposed to live? Probably not. Most financial advice stops at the number. Save 3 months, save 6 months. Great. Now what? Here's the thing about the 3 to 6 rule. It's not wrong, but the number itself is almost beside the point. What actually matters is your specific situation. Do you have stable income? Does a partner bring in a second paycheck? Could you pick up freelance work if you had to? Is your industry the kind where layoffs tend to be short or long? Those answers change your number more than any rule of thumb does. Does that make sense? A teacher with tenure and a working spouse probably needs 3 months. A freelance designer in a down market probably needs 8. Same rule, totally different answers. But the bigger problem, most people who have an emergency fund at all are parking it at their regular big bank and earning almost nothing on it. According to the FDIC, the national average savings rate is 0.38% APY. That's not a typo, 0.38% on money you worked hard to save, on money sitting there doing a job. Bankrate is currently listing top high-yield savings accounts at up to 4.10% APY. No minimum balance required, FDIC insured up to $250,000. That gap between 0.38% and 4.10% on, say, a $15,000 emergency fund is roughly $540 a year for doing nothing except opening a different account. Now, a word on where that money should not go. Some people hear high interest and think CD. Makes sense intuitively. Lock it in, earn more. But a CD is exactly the wrong home for emergency cash. Think of it this way. A CD is like keeping your spare key in a locked box. The key is technically safe, totally secure. But when you need it at 11 p.m. in the rain, the locked box is a problem. Emergency money has one job. Be there in 24 to 48 hours. A CD with an early withdrawal penalty cannot do that job without costing you money. That penalty exists precisely because they want you to leave the cash alone.
So, the takeaway here is short and specific. If your emergency fund is sitting at a big bank earning under 1%, move it. This week, open a high-yield savings account. Transfer the balance. Done. 10 minutes of work, hundreds of dollars a year in return. And once that cash is positioned correctly, the next question becomes, what about money beyond the emergency fund? Because that's where CDs actually start to make sense.
So here's the one question that settles the whole CD debate. Do you need this money in the next 12 months? Yes? Stay in the HYSA. No, a CD is worth a serious look. Here's why that single question matters. According to Fortune, top 12-month CD rates right now are sitting around 4.30% APY. That rate is locked in, guaranteed for the full term. Your HYSA, on the other hand, can drop the moment the Fed signals a cut. And honestly, people spend more time researching which streaming service to cancel than they spend deciding where to park $10,000 in cash. I've been there. Don't be me. Now, the trade-off is real, and you should understand it. An HYSA pays competitively today, but the rate is variable. A CD locks in that rate, but there's a catch. Pull the money out early and you pay a penalty. On most short-term CDs, that's roughly 3 to 6 months of interest. So the only cash that belongs in a CD is cash you genuinely will not touch. The math difference isn't dramatic, but it's real. Think of it this way. If the Fed cuts twice before year-end and HYSA rates follow, you could end the year earning meaningfully less than if you had locked in. That spread matters on any balance over a few $1,000s. But what if you want rate protection and you're nervous about locking everything up at once? That is exactly where a CD ladder comes in. You split your lump sum across 3-month, 6-month, and 12-month CDs. Every few months, a chunk matures and comes back to you. You're never fully frozen, and you've captured the locked rate on most of the balance. Is the ladder the perfect strategy? No, there is no perfect strategy, but it covers the realistic scenario where you're not totally sure when you'll need the cash. Good enough beats perfect every time. Okay, you now have the framework. The next step is turning it into 2 actions you can complete before June 17th. That's where we're going.
So here's the checklist. 2 steps. Do them before June 17th. Step 1. Find your emergency fund balance right now and check what it's earning. Pull up the account. Look at the APY. If the answer is below 3.5%, that's not a decision point. That's a to-do item. Bankrate is showing top accounts at 4.10% APY right now. The gap between what you're earning and what you could be earning is just inertia. Step 2 is for cash beyond your emergency buffer. Ask yourself one question. Will I need this money in the next 12 months? If the answer is no, that money deserves a 12-month CD or a short ladder before the meeting. Rates could move after that dot plot drops. Good rates locked now beat uncertain rates later. Here's why the deadline matters. June 17th is when the new projections come out. Not the rate decision itself, but the signal about what comes next. If the dot plot shifts toward cuts later this year, savings rates start adjusting before the Fed actually moves. Banks don't wait. The Fed is going to do what the Fed does. You don't have to care about the meeting. You just have to do these two things before it happens. Check your rate, move the idle cash. That's it. I'd flip the coin here, but honestly, this one isn't a coin flip. It's just homework.
All right, that's a wrap on this one. Here's the thing about today's episode. We talked about the Fed, savings rates, emergency funds, CDs, but the real point was simpler than any of that. You probably have cash sitting somewhere right now earning almost nothing, and there are accounts paying 4.10% that you could move it to this week. The June 17th FOMC meeting is the clock on this, not because the world ends after it, but because the dot plot that comes out of it would tell us where savings rates are heading. And according to Bankrate, the top high-yield accounts are at 4.10% APY right now. That window exists today. We also talked about the emergency fund question, and I want to land that one cleanly. There is no universal right answer. 3 months might be perfect for your situation. 8 might be the honest number for someone else. What matters is that whatever cash you've set aside for emergencies is working for you while it sits there, not dragging at 0.38% at a big bank. 0.38? That's the FDIC national average. That number should bother you. A little. And then the CD question. The short version, if you have cash you won't touch for 6 to 12 months and you want to lock in today's rates before they drift lower, a CD ladder gives you both protection and flexibility. You don't have to pick one or the other. So here's the 2-step checklist before June 17th. 1. Check your current savings rate. If it's below 3.5%, you're leaving money on the table and it takes about 10 minutes to fix. 2. If you have cash beyond your emergency fund, decide whether a CD or a ladder makes sense before the dot plot shifts the conversation. That's it. Make the call, move on with your life. Thanks for spending this time with me. If today helped you make even one decision you'd been putting off, that's a win. Subscribe wherever you get your podcasts so you don't miss the next one. And if you've got a money question you've been sitting on, drop it in the reviews. I'll read them, and it might just become the next episode. I'm Derek Wu. This is Coin Flip. Talk soon.